In today's video, we'll discuss payment for order flow and the pros and cons of using brokers who promote free trades and use payment for order flow. Payment for order flow has become a controversial topic in the investing world, with some arguing that it's beneficial for individual investors, while others argue that it's detrimental to the markets and individual investors. What is payment for order flow? Payment for order flow is a practice in which brokers receive compensation from market makers for routing trades to them instead of executing them on public exchanges. In other words, brokers get paid for sending orders to certain market makers or trading firms rather than executing those trades on an exchange. Pros of payment for order flow. The primary benefit of payment for order flow is that it allows brokers to offer free trades to their clients. By receiving compensation for order flow, brokers can offset the cost of executing trades for their clients, making it more affordable for individual investors to trade stocks. Another benefit of payment for order flow is that it can lead to better execution quality for individual investors. Market makers and trading firms that receive order flow have an incentive to provide better prices and execution for those orders, which can result in better prices for individual investors. Cons of payment for order flow. One of the main concerns with payment for order flow is that it can create a conflict of interest for brokers. When brokers receive compensation for routing orders to specific market makers, they may be incentivized to route orders to those firms even if it's not in the best interest of their clients. Another concern is that payment for order flow can lead to lower liquidity and wider spreads in the market. When market makers receive a large amount of order flow, they may not need to quote prices as aggressively on public exchanges, leading to wider spreads and lower liquidity in the market. Finally, some argue that payment for order flow can harm price discovery in the market. When orders are routed to specific market makers, those firms may have more information about the market than other participants, leading to a distortion in price discovery. That's all for today's video. Thank you for watching, and please don't forget to like and subscribe to our channel for more content.